now tuned into the Money Level Show.
Hello, everyone. We are back with Dr. Nomi Prins. How you doing today?
I am great. I'm so happy to be back on.
Yes. I definitely appreciative of your time. Always enjoy engaging with you, connecting with you at the Rule Symposium and such. Yeah, you have a lot of insight. You're always boots on the ground, ears on the ground. You know, you're traveling and just showing people like, okay, this is what you're seeing. And so I'm always appreciative of the print sites. So I wanted to talk a little bit about this dynamic with uh, President Trump. He wants to lower interest rates. He wants interest rates to be lower. He also wants taxes to be lower. I mean, there's other dynamics of the income tax and everything. And I just don't know how realistic some of this is. Some of our audience probably don't know how realistic some of this is and how much income tariffs are going to bring or whatnot. But there seems to be I don't want to say it's heating up. I mean, Jerome Powell dodged the questions very in a savvy way on the last press conference. But just wanted to get your take on what do you think about this dynamic? What are some things that you're seeing?
Yeah, no, I appreciate it. It's a really interesting dynamic that Powell and Trump have. I mean, first of all, in this first term, President Trump was the one who actually appointed Powell, who at the time was kind of the number two at the Federal Reserve Board of Governors into the number one spot. And then President Biden reconfirmed him. And so we've had this sort of bipartisan acceptance of Powell. That said, during the first term. Not too different from what's going on now when Trump had invoked tariffs against China, Mexico, Canada, and so forth. There was a concern from Powell at the time that that could increase inflation. And as a result, he was reticent to cut interest rates around that time. At the same time, that was what Trump was pushing for. Now, to put all that in perspective, because I think it's really important, and we just did a piece on this with the charts and everything at Print Sites, um, the inflation rate at the time, from the standpoint of the producer price index, which isn't necessarily the favorite Fed index, but it's an important index to monitor productivity, manufacturing, and so forth, was where it is today, right? So there was a very barely any discernible difference between what inflation from that perspective was then to what it was today. The difference is that interest rates back then were between 2.25% and 2.5%. And of course, today they're between 4.25% and 4.5%, having been cut by 100 basis points last year. So they were significantly lower. Tariffs were coming in. Inflation was the same. And Powell's initial reaction was not to cut rates when pressured by Trump. Now, he did ultimately cut rates not too long after, at the end of 2019, to 1.5%. And he did that because the banking system was struggling and had liquidity issues. And so he wound up cutting rates for another reason, but sort of covering that cut. And then, of course, we had COVID, rates went to zero, quantitative easing blew out of control, and so forth. So we look at today from that lens, and rates are 4.25%, 4.5%, inflation is similar, and Trump is back again saying cut rates, and Powell is saying no. But Powell also didn't really stick the idea of we're only going to have two rate cuts this year to the extent that he did in December at this latest set of meetings. It's still out there, but he didn't sort of push it. So what I think will happen is Powell, as he did last year with the labor market being weaker, will find another reason to cut rates, will recognize the Fed cannot control inflation at the margins, particularly for real assets, and will ultimately cut rates, and we predict by 100 basis points this year instead of 50. Now, I don't think that's going to happen in the first quarter or the first half of the year, but I believe by the end of the year, that is what we're going to see. And the Fed will pivot to finding another reason to save face from, sort of accepting Trump's push on rates, but finding another reason to cut them as it did between 2018 and 2019 during a tariff period. So it's an interesting dynamic to watch. But I think at the end, the Fed net of Trump is in a position where it is concerned about tariffs. But also, if you look at all these dynamics and all these factors in the lens of history and today, he's also got to look at economic growth declining and slowing down. And that's going to be something the Fed's going to need to take action on, or it's going to decide to use as an excuse to take action on to cut rates.
Hmm. Got it. Got it. So the Fed started cutting rates in 2019. That was the reverse repo market. I think we had a
That's right.
spike there or something,
That's right.
and that was because of the issues with the banking system. What is your assessment of the banking system now? Is it in a healthy space, or like what's your take on the banking system now?
Yeah, and this is a great question because we've also covered that this year, because obviously that's a big component that no one talks about at these Q&As anymore with the FOMC. It's just all about inflation, which is just ironic because again the Fed can't control inflation. It can't really control what the banks do. It can control liquidity to them. The banks are facing growing delinquencies in commercial loans, to the extent that the rate of delinquencies is where it was during the financial crisis lead-up period in 2008. Now, not all of those loans are housed on the books of the biggest banks, so it doesn't look like it's as big a calamity growing. They're mostly regional banks. The regional banks have credit lines with the big banks. So even though the big banks are saying, well, this doesn't really affect us, the reality is, as we know, if there is an acute problem in the banking system, as we saw in March of 2023 with the banks that fell apart because of um, other types of extractions of deposits and not being able to fulfill them, it impacts the entire banking system. It certainly impacts what the Fed does. In March of 2023, the Fed increased quantitative easing. In the wake of 2019, the Fed cut rates and also increased quantitative easing. I think both of those things can happen because the banking system is facing growing commercial loan and office problems. And the other thing about that is that we've already undergone a period. The New York Fed calls it extend and pretend. It's what we all call it as well. But the fact that they're actually using the term is interesting, because what it meant was a lot of the banks reconstituted these commercial loans, extended them out longer. Didn't necessarily reduce their interest rates because rates haven't come down in the long end. They just sort of rejiggered them by extending them. And that gave them a little bit of peace, some of these commercial loans. But now they're coming up against actually not being able to pay on the extended loans. So we're seeing the sort of double down of problems that were creeping up that weren't evaluated properly on the books of banks. So I definitely think there's banking trouble on the horizon. It's real. And just adding to that, we have had a lot of bankruptcies and closures of major companies in the retail space, closing their actual footprint, reducing the number of stores that they have open. So, for example, CVS, Rite Aid, Walmart. So what that means is there's less office space getting rent even to pay into any loans that might be connected to banks. And that's something that hasn't really stopped because we haven't seen rates come down significantly, and we are seeing all these changes in how the consumer buys things and this reduction of that, physical footprint. So that also adds to problems that banks could be facing.
Okay, so thank you for mentioning that. That was very laid out well. So with the banking sector, the Fed has cut rates on the the shorter end, but not the longer end, which these long-term loans with higher interest. I mean, I know that some banks had to, or organizations, the companies had to refinance debt at higher rates.
Right.
This has also been a problematic for consumers, especially with mortgages and things of that nature. And so it seems like the Fed at some point is going to have to do some yield curve control or something to even mitigate that. Is that where you see them going? Is cutting rates and going back to like quantitative easing, or what are you thinking there?
That's a really good point, and I think they would prefer quantitative easing because it's sort of behind the curtain, even though it is public. I mean, they have a report every week that shows how much quantitative easing they have on their books, which is still around $7 trillion, which is much more than the 4.5 trillion it was in the wake of the financial crisis. Because of COVID, they haven't reduced it by that much, and I think a lot of that is because of the expense of the long end, and also central banks around the world aren't buying as many treasuries. And so there aren't as many buyers for that long end. So you have just a lot of things impacting the long end of the curve. So I do think that at the slightest um, public whiff of banking issues, however they manifest acutely, that will be followed by some form of quantitative easing first before cutting rates. Because again, cutting rates is helping reduce the rate level and cost at the front end of the curve, but hasn't fulfilled sort of up the curve. And they can't really do any more yield curve management than that. They could cut rates because of that. And again, I still think we're going to get 100 basis points cut this year on the front end, but they need to do something with the back end as well. And I think they're either going to stop all forms of quantitative tightening or add quantitative easing to help that scenario.
Yeah, because so foreign countries aren't buying as many bonds or treasuries to help reduce that long end of the interest rate. I mean, right now, I think we just have maybe pension funds or and mostly American uh, related things that are purchasing that long end. Is that correct?
Yeah, I mean, for the most part, we still have central banks buying the long end. You have still the Bank of England and so forth, but what and Bank of Japan sort of comes in, and but the level of treasuries that central banks hold around the world, for the most part, besides our very, very core allies, has dramatically dropped, and it certainly dropped as a percentage of the amount of debt we have. So, just as an example of a number, the People's Bank of China, the Central Bank of China in 2018. So again, when the first set of tariffs started and we started the whole tariff war watch, they were holding $1.3 trillion worth of US Treasuries. Now, at the time, our public debt was like around 9 trillion. So, so they were holding A more and B, a higher percentage of outstanding US Treasury debt. Today, they're holding about $750 billion worth of debt, and our debt is at $36 trillion. So they've reduced their holding of our debt, and they were the second largest holder next to Bank of Japan. They kind of flip back and forth in terms of the amount of treasuries, or the most treasuries a central bank held, but they basically dropped by a half. They've increased their gold holdings, they've done other things, but it's a far less significant component of our public debt. So that's definitely something that's happening.
Yeah. Okay. So like our debt is increasing so fast.
Right.
I mean, you mentioned 9 trillion back in 2018, and I was just doing the math in my head. I was like, yeah, we've been spending about 7 trillion a year, something like that. Um, but so it's been increasing so fast that central banks aren't even covering like how much our debt is increasing, and a lot of this seems like structural with like Social Security and our biggest expenses, and obviously the interest expense on the debt. I was also wondering about the strength of the dollar and what that plays into foreign central banks selling treasuries, selling bonds to get the dollars they need to finance their debts. You have any? Is that? I mean, I'm sure that's something that you factor in the equation as well.
Yeah, it's interesting because the dollar has remained strong, and certainly, I mean, it's weakened a bit this year, but it's certainly remained in a range to strong over the recent period. And what that means is any countries that have financed in dollars and have to refinance any debt that they owe, whether it's corporate debt or public debt, the United States are having to basically not get a break on refinancing that, both from a standpoint of rates as well as a standpoint of a higher dollar. That said, the fact that the dollar has remained so high um, is really, I think, an indication of how generally the world thinks of economies and growth of economies, and still assumes that the U.S. economy, on a comparative basis, is going to remain strong, and has basically continued to lend credence to the dollar for now. And that's really been the case. I mean, the dollar is used sort of less in trading. More trade alliances are happening outside of US dollar uh, settlements and so forth over time. But at the same time, it has continued to remain relatively strong because of it, sort of the best economy on a bad block, or however you consider it. Um, and that's something we've seen. That said, we've also seen a lot of gold purchasing against the dollar, and gold continues to rise relative to the dollar and in dollar terms. So that's a way of also expanding how we look at evaluating currency and hard asset factors that have currency aspects to them.
Yeah, yeah, definitely. So I was recently reading an article from the Financial Times. This article stated that uh, people in New York are buying, uh, I guess, billions of dollars worth of gold, and the Bank of England is having to, they're having a backlog to pretty much deliver that gold or whatnot. And so, and we see gold at all-time highs measured in dollars and such. And so, what is your outlook on gold like moving forward? I mean, we've had many tailwinds for it. It's going up higher while the dollar still remains strong. The dollar hasn't really declined very much. I mean, I think the DXY was in like the 90s at one point, and so in recent history. But yeah, so just wanted to get your take on where you think gold is headed.
Yeah, so I believe gold can get into 4,000s as we get to 2026. I mean, I think we'll hit 3,000 uh dollars really soon. I mean, we're already over 2850 or whatever it is, as of today. And gold was incredibly resilient in the wake of the election last year. I mean, it did sort of get hit a little bit as the dollar strengthened on the back of the election results, but it really perked up very quickly from there. And that's because there's so much diverse attention on gold. There's certainly central bank buying that's sort of the accelerant in terms of demand for physical gold, and that will continue because there is a drive to diversify reserve against the dollar. This is just a fact. And also gold gives a backing to other countries to trade with each other. I'm not saying there's a gold standard net of the United States dollar, but there's certainly that idea that if you have a certain amount of a physical asset in your reserve, that lends strength to transactions, that lends strength to trade settlements, and so that's going to continue. There's literally nothing on the horizon to change that direction. And then we have a lot of other things that have happened in gold. We had inflows into ETFs in gold in China, and effectively in India, basically in BRICS countries and so forth last year. That continues to be the case. We had some outflows in gold miners at the end of last year. We saw sort of interim highs in October, and then into the election, they sort of fell off, and now they're creeping back up again. So we have yet to see the Western investor really coming into gold mining stocks and staying in gold mining stocks. But we have seen that turn around as well early this year, and I think that's going to continue. So I think the tailwinds for gold and gold miners are really in place, and I don't see anything really coming beyond general market volatility here and there to change that.
Yeah, 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 and not to get like off topic, but it's kind of interesting with the same similarly Bitcoin being at all-time highs, and then you got the ETFs that have direct correlation and exposure to Bitcoin. Those have been increasing as well, but the Bitcoin miners that actually mine the Bitcoin have been struggling significantly, and it kind of reminds me of gold. Like you have gold, the physical metal, that's doing well, but the miners are still kind of struggling. And for me, like I'm more into the royalty and streaming companies, just to help diversify some of that risk. But that's been something that I've been keeping an eye on is the miners as well. What are some of the top commodities that you're looking at? So there's a lot of different narratives. We got drill, baby drill. We got the rare earths dynamic, where most of those are coming out of China. We have enriched uranium coming out of Russia and such. And so, and there's like this global trend, or at least a trend within the U.S. To really bring production and materials and extracting resources from our country. And so, just wanted to get your take on like what are the top commodities that you're looking at for this year?
Yeah, so definitely looking at uranium, as you mentioned, enriched uranium is something that we do rely on Russia and Kazakhstan, which has a tight connection with Russia and things for, but we also have an act that was passed, which effectively went into play last August to ban a lot of that import, not completely because we do have extenuating circumstances where we don't have enough here to power our nuclear power, which is 20% of U.S. energy resource. So there is timing and there's language within legislation that effectively recognizes that. That said, um, this administration, as the last administration, is very cognizant, as is bipartisan politics, of the fact that we need to be more reliant on our own sources or allied sources of uranium and processing. And so I think that those companies, mining companies, as well uranium prices themselves, are going to continue to rise domestically and domestic allies of the United States throughout this year. So definitely looking at if you're an investor buying on the dips that we've seen, looking at a long-term view, and looking at mining companies that have a global footprint but are effectively allies of the United States or in the United States for production and processing. And the same for rare earths. Rare earths is a little bit of an out there thing for investors. You have to really be focused on it to recognize what's happening. But in the first week of executive orders of the Trump administration, he had a lot of stuff out there, but from an energy perspective, talked about energy emergencies, talked about obviously oil, natural gas, but also about critical minerals, which include rare earths. In fact, specifically mentioned rare earths in the executive order statements as being something that we needed to have domestic control of. Now, as you said, a lot of the supply for rare earths, 60% of it comes from China, 90% of the processing comes from China. There's a big road ahead to, sort of overhaul. But at the same time, there are other places in the world that do have rare earths or are mining them. There are companies in the United States, for example, Energy Fuels that has mines outside of the United States and can process in the United States. And I think companies like that, again, these are long-term evolutions, but we'll see ultimate upside from this domestic focus on rare earths. Rare earths are obviously intrinsic to national security, permanent magnets, defense, NASA, and so forth. And also countries like Brazil, where there are abundant amounts of rare earth minerals, and the United States hasn't quite officially recognized that that is a good place for rare earths and processing, although companies have. So I think that's something to watch as well as gold and as well as silver, as well as copper, because I think ultimately those are globally demanded elements for different reasons that require require a time lag, and that just have more demand than supply is available out there.
Got it. Got it. So yeah, I was actually looking at some rare earth ETFs, VanEx in particular. I think it's REMX or whatnot. But I was looking
Yeah.
at their holdings, and their holdings were majority like foreign countries. Like they had those couple of Chinese companies and whatnot, and this whole dynamic with like tariffs and wanting to bring production back. Like obviously, that's not materialized yet because you have to build infrastructure, factories, and
Exactly.
all of that. And so I was
Yeah.
kind of thinking about that, and I was just like, is this a good long term thing? If I buy this ETF and they're mostly positioned in China, which then there's these dynamics there, and so I was kind of just thinking about that, like, okay, should I focus more on U.S. based companies for this, or what? It was kind of, I was struggling with that.
Well, it's interesting because again, the rare earth space is a very long-term play. It's still speculative for general investors, which means even if they invest in rare earths, they're very quick to come out at the slightest hint of prices dropping, which they did last year. And also rare earths cover like 17 different minerals, of which only 4 are really used for battery technology and permanent magnet purposes. So it's like who's extracting those, who's processing those, where's it coming from? So I think it's probably better not to do the ETF, but to look at companies even within that ETF, but that are effectively out of China, because at the end of the day, they are still long-term investments. But we're looking at the potential of rare earths to be really more domestically considered as processing infrastructure, of course, unfolds as well by the United States and by using its allies. So I think they're long-term investments, and I think they're ones that you sort of buy and just don't look at for years, but that could really provide a lot of returns. Now that, again, the Trump administration, on the back of Biden administration, actually did this as well, but are sort of continuing that line of, all right, we need to do something about our own supply and processing and supporting the companies involved in that.
Yeah, got it, got it. That makes sense. So, as we wrap up, just a question I just thought of. So, you were heavily in the banking system, and now you're like, you know, big into commodities and researching these macro dynamics and how they affect commodities and such. And so, how is that? Do you see that as like a transition for yourself, like a evolution, and from like, being specific to banking to like now, you're kind of marrying the whole process of everything, and all these other dynamics. How's that been for you?
Yeah, that's a great question, because it has been an evolution for me. And part of it's intellectual curiosity, sort of I know banks, I know finance, I know leverage loans, I know derivatives, and looking at real assets, and commodities that do have value, investment value, but also have use value and are real. Just became sort of more of an interest to me, and energy is kind of the link, or and AI as well, which requires energy, but there are links that continue to evolve between commodities and sort of their use values. And so I think that area is pretty fascinating. So for me, it's definitely an evolution, and I like to keep myself curious and learning, and involved in visiting what's going on out there. And so I think all of that's been a transition, but a natural transition over my career.
Yes, yes, that's great to hear. So where can people find your site and where you do your write-ups? I know you're on Substack and such.
Yeah, I mean that's really where I'm focusing my writing and recommendations, depending on the tier people sign up for. So it's printsites.substack.com. And we do a lot. We just had our we do a January a monthly wrap. So we just had our wrap come out right before I got on with you actually, and we do a lot. We cover a lot of areas as well as a lot of specifics. And I just started it like 7 months ago, so I'm pretty focused on that, and really just proud of how it's growing. So that's really the best place to find my work.
Yeah, yeah. Well, I'm gonna link to that in the description below. Be sure to go check out Dr. Nomi Prins Substack and newsletter. You're getting the expert in the banking sector, but also, I mean, in the commodity sector. I mean, I've been reading some of the articles that you've been putting out. I'm gonna check out the one today. It's kind of it's kind of interesting. There's so many. I have so many interests with Substacks, and I got all these Substacks coming up, and I'm just like, oh, which one do I read? But you're one of the ones that I think provides a really, really great value. And so, especially for my understanding of the macro environment and what's happening, because you are boots on the ground. So, yeah, appreciate you for coming on and everything. And thank you.
Thank you so much, Daryl.